They're dying, no grass, no water. Farmers can barely get a few dollars if a cow collapses and a butcher happens to be nearby. If the rains don't come soon, the outcome will be catastrophic. In 2022, Ghana's currency, the Cedi, was the worst performing in the world. By mid-2025, it had done the impossible, becoming the best. A shocking 50% rise against the US dollar sent shockwaves through global markets, leaving economists baffled and investors scrambling. How did a currency once crushed by inflation, debt, and fear stage the most stunning comeback in recent memory? What exactly happened? Who made it possible? And what risky decision flipped the script? Let's dig in. Before the recovery, before the headlines changed, before the IMF came calling, Ghana turned to its most undervalued asset, the ground beneath its feet. As global trust in the Cedi collapsed, Ghana didn't beg, it pivoted to power. It turned to gold. But not just by mining or exporting more. Ghana flipped the global finance playbook and asked a question few dared to consider. Why are we still pricing our wealth in foreign currencies? The Mahama administration acted boldly. In a move that stirred both applause and quiet fear among international observers, Ghana rolled out a new economic rule. Anyone buying Ghana's gold, local or international, would have to pay in cedis, not dollars. This wasn't a suggestion. It was mandatory. And just like that, the Cedi became desirable again. This wasn't just smart policy, it was perfect timing. As fears of global recession and conflict pushed gold prices higher, Ghana stood at the center of the storm. By May 2025, gold had skyrocketed from $2,000 to over $3,400 per ounce. Suddenly, Ghana became a magnet for gold-hungry investors. But this time, there was a catch. They couldn't touch the gold without first converting to Ghana's currency. The effects were immediate. 1. Foreign firms flooded Ghana's markets to buy cedis, boosting its value almost overnight. 2. The Bank of Ghana's gold reserves surged from 9 to 31 tons in just 18 months. 3. The Cedi wasn't seen as weak paper anymore, it became a gold-backed instrument of economic pride. This shift in perception was as powerful as the policy itself. For years, emerging markets were punished for lacking strong currency backing. Ghana changed the story. It declared, our money is not empty, it's backed by something the world can't ignore. And suddenly, the Cedi wasn't just surviving, it was trending. Global traders who once avoided the currency now saw it as a tool for profit. The demand rose silently, but when it hit, it exploded in the exchange markets. By Q2 2025, the Cedi's strength was making global headlines, not because of hype, but because of real economic muscle. This wasn't just a temporary rebound. It was the start of deeper reform. With rising reserves and renewed investor interest, Ghana's government gained something it hadn't had in years: space to fix the underlying issue, inflation. Gold didn't fix everything, but it gave the central bank a weapon it hadn't held in years: leverage. Before inflation can be controlled, before investment returns, before global markets take a country seriously, the people must believe in their own currency. Gold gave the Cedi not just value, but credibility. Still, credibility alone isn't enough. It has to be protected. And Ghana's central bank stepped in, not quietly, but forcefully. Backed by rising reserves and public confidence, the Bank of Ghana, BAUG, made its move. Inflation was the beast. Now, it was time to fight back. With a reputation rebuilt and reserves to back it, Ghana had something rare: a second chance. But second chances fade fast unless fiercely defended. So BAUG didn't blink. In March 2025, the bank shocked markets with a sudden aggressive rate hike, raising interest rates by 100 basis points to a massive 28%. There were no leaks, no press conferences. Just a silent surgical strike against Ghana's most dangerous threat: runaway prices. It wasn't just a headline, it was a warning. A signal to citizens and foreign investors that Ghana had moved from defense to offense. Inflation had once drained savings and paralyzed business plans. Now it was being targeted, relentlessly. This wasn't about calming nerves. It was about reprogramming behavior. High interest rates hurt in the short term, borrowing slows, credit tightens. But discipline returns. Banks are told to guard cash. Investors are forced to calculate, not gamble. It was Ghana saying, we're willing to endure short-term pain to restore long-term value. And the world noticed. But BAUG didn't stop there. In another bold break from the norm, Ghana's central bank ditched behind-the-scenes currency interventions and embraced full transparency, public spot market auctions. No more secret dollar sales. No artificial exchange rates. If you wanted foreign currency in Ghana, you had to bid for it, out in the open. This transformed the market instantly. It crushed the black market hoarding that had undermined the Cedi for years. It increased forex liquidity, letting prices reflect actual supply and demand, not fear and rumor. But most importantly, it made the Cedi trustworthy again. Not just to analysts and traders, but to everyday people. People who had seen their savings wiped out in past crises. Slowly but surely, citizens started keeping cedis instead of racing to convert them. Businesses began signing contracts in cedis again. Confidence came back, not loud, but steady. And that's what BAUG needed, to stay bold. But here's the truth. None of this is possible in isolation. Without strong reserves and public trust, surprise rate hikes trigger chaos. But Ghana wasn't in that fragile place anymore. It had fought its way out, with gold, guts, and grit. And the world is finally watching. Not by luck, not by slogans, but by strategy. Gold-driven inflows gave Ghana a cushion. Clear communication gave the public confidence. So when the Bank of Ghana tightened monetary policy, it faced pushback, but not chaos. Still, central banks have their limits. Trying to tame inflation with interest rates alone is like squeezing a balloon. Pressure just bulges elsewhere. Without sound fiscal policy, those monetary gains would vanish. Ghana had inflation on the ropes, but it wasn't finished. Interest rates bought breathing room, not a cure. Lasting stability, deep, structural and institutional, demanded more. The government had to tackle runaway spending, trade imbalances, and a swelling debt profile. Without that, even the best central bank moves would collapse under their own weight. That's when Ghana brought in the one partner it had once feared, the International Monetary Fund. For many countries, the IMF means pain, emergency loans, deep cuts, protests in the streets. But in late 2024, Ghana flipped the script. This wasn't a last-ditch cry for help. It was a deliberate, calculated move, a partnership to back reforms that were already in motion. Ghana wasn't chasing dollars. It was securing time, credibility, and a signal to the world that it was serious. The result? A $3 billion extended credit facility, stretched over 3 years, not just to loan money, but to enforce discipline. But before we continue, please like and share this video, and subscribe for more stories of Black resilience, history, and truth. Now, here's what happened. First came the brutal cuts. The government froze 65 billion cedis in unpaid obligations. It was politically dangerous, but financially essential. Instead of borrowing more to cover past mistakes, Mahama's administration slammed the brakes. Ministries and contractors were told to go back, prove every invoice, and start over. Then came borrowing reform. For years, treasury bills had offered sky-high returns, 28%, drawing money away from the real economy and swelling public debt. Under IMF guidance, yields were cut nearly in half, down to 15%. Suddenly, lending to the government wasn't easy profit anymore. Banks had to go back to what they were meant to do: finance businesses, fund trade, and back innovation. At the same time, revenue collection got a makeover. This wasn't about raising taxes. It was about fixing the broken system. Digitizing the tax authority, closing loopholes, bringing small businesses into the net, these became top priorities. The goal? Make tax the rule, not the exception. But the IMF's real value wasn't technical, it was psychological. With that stamp of approval, investors saw Ghana not as a debtor in distress, but as a performer on a mission. Yields fell. Capital returned. Foreign investors came scouting. Credit ratings stopped their decline. Even remittances picked up, as the diaspora sensed a shift in national direction. And the Cedi? It held strong. Not because the IMF pumped in cash, but because markets believed Ghana would stay the course. But belief is fragile, especially in politics. Cutting payments makes enemies. Lowering yields angers banks. Austerity hurts. When pressure builds, politicians often panic. But Ghana didn't. Why? Because it had what so many countries lack: steady leadership. The IMF can design plans. The central bank can enforce policy. But only consistent, mature political leadership can hold it all together. Without that, the reforms would have cracked. Interest rate hikes would have lost bite. And the Cedi would have bounced back, only to crash again. But that's not what happened. Because after a dramatic return to power, Mahama didn't gloat. He didn't scapegoat. He governed. Not with drama, but with clarity. No midnight purges. No fights with the central bank. No empty press conferences. He offered what investors and citizens craved: predictability. He respected the central bank, even when its policies hurt his own supporters. He didn't shield insiders from the cuts. He didn't hijack the IMF program for photo ops. He let professionals do their job, and protected their space to do it. In a region where leadership often veers between populism and autocracy, Mahama's calm governance became a superpower. He didn't use parliament to ram through reckless spending. He made the hard case, for restraint, for structure, for responsibility. And when resistance came, from MPs, lobbyists, contractors, he didn't blink. He wasn't trying to be liked. He was trying to prevent collapse. And abroad? His diplomacy was precise. No circus. No false promises. He strengthened Ghana's image with quiet, calculated moves. He brokered trade deals behind closed doors. He opened energy talks with Gulf partners. He deepened cooperation with West African neighbors to secure trade routes and cross-border stability. All this built Ghana's soft power, not with headlines, but with results. As gold exports boomed, investors felt safe knowing policy wouldn't shift overnight. As inflation dropped, employers trusted that wage laws wouldn't suddenly change. And as the Cedi surged, import lobbies weren't allowed to hijack the agenda. But Mahama's biggest impact? He gave the people something they hadn't felt in years: calm. After waves of economic chaos, what Ghanaians needed wasn't just reform, they needed emotional recovery. Mahama's speeches were honest, measured, and forward-facing. His team functioned with unusual focus. He didn't politicize every decision. He didn't play the hero. He acted like a steward of something bigger than himself. And the payoff? Ghana didn't just regain investor confidence, it rebuilt the trust of its people. And that's a currency no central bank can print. Now you've seen the full arc. This wasn't luck. It was a chain of choices, each one intentional. Each decision alone might have sparked a ripple. Together, they created a wave. This wasn't a speculative rebound or a lucky quarter. It was a symphony of moves, strategically sequenced across 4 key arenas. Each decision unlocked the next. Each player stayed in step. And now, what Ghana has isn't just a strong currency, it has a strong system. Because real economic miracles don't happen by chance. They're constructed, with discipline, timing, and structure. Ghana didn't try to fix everything at once. It focused. It paused when needed. It advanced when ready. Each action had a purpose. Each pause had a reason. And that's why this comeback didn't fall apart. It wasn't perfect, but it was ordered. Like a reverse domino effect, each piece supporting the next. Because gold alone doesn't save nations. Neither do IMF deals. Nor calm presidents. It's the combination, and the sequence, that matters. Plenty of nations have the pieces, and still crumble. Ghana had a blueprint. And it followed it. It turned panic into planning. Chaos into rhythm. And a falling currency into a disciplined signal. Most recoveries fall apart during the celebration phase. When danger feels distant and leaders get comfortable. But Ghana stayed sharp. Even when the Cedi surged, officials made it clear, this wasn't the end. This was only the beginning. They refused to get distracted. They refused to let up. And that mindset made all the difference. Because what matters isn't just gaining value, it's knowing how to defend it, to sustain it, to evolve it. What we've witnessed is rare. A moment when politics, policy, and patience work together. No egos. No shortcuts. Just design, not luck. That's why the Cedi is no longer just a currency. It's a message. A sign that when strategy aligns, dignity can return, even in the most fragile economies. A message that nations in the global south don't have to wait for permission to rise. They can chart their path, own their resources, and write their future. And yet, this isn't the final chapter. It's only Act 1. Risks remain. Markets change. Oil prices shift. Elections loom. One misstep could undo progress overnight. But if the past 2 years have shown us anything, it's this. Ghana doesn't just fight back. It fights smart. And that strategic discipline? That's the real power behind the Cedi. Now here's a question for you. If Ghana can do it, why can't others? Could this be Africa's true awakening? Let us know in the comments. And if you want more stories like this, don't forget to subscribe and tap the bell icon. This channel is here to reveal what's been hidden: Black culture, truth, history, and legacy. Thanks for watching. And stay tuned, there's more to come.